Welcome to the channel. In this video I'm going to introduce a series that I'm bringing to YouTube. It's going to cover the accounting fundamentals that's going to make life so much easier if you're studying for accounting or you're thinking about starting a career in accountancy. If you like this video, please like it, subscribe, and yeah. So without further ado, let's get into it. So in this video we're going to cover the basic accounting equation, what it's made up of, how does that relate to debits and credits, and finally we're going to do some examples of how debits and credits are used in everyday life. I've also got a really useful tip on how to remember what's a debit and what's a credit, so make sure you watch till the end to learn how to do that. So the accounting equation is made up of three components. It's assets equals liabilities plus equity. Now, if you're completely new to accountancy, you're not really going to understand what any of those mean. You're going to have heard of assets and liabilities and equity all in different scenarios, but you're not going to understand how they all link together. So first of all, let's get into exactly what each of these components mean and break it down by definition. An asset is a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. If we break this down by each word, a resource can be tangible or intangible. An example of an intangible asset would be a patent or a trademark, and a tangible asset could be a camera, a computer, or something that you can touch. An entity is an individual or a company that has the right to control an asset. So I am an entity, but also a limited company is also an entity. It's really important to know that an individual and their incorporated company are two completely different entities in the eyes of the law. As a result of past events means that something has happened in order to give you the right to control the asset. So you could have signed a lease agreement, or you could have exchanged cash in order to own a camera, or along those lines. And finally, future economic benefits essentially just refers to cash coming into the business. So economic benefits of a camera would be if you take photos and you sell those photos, your camera is generating you cash, and that's why it would be classed as an asset. So in a nutshell, assets are what earns you money. So let's move on to liabilities. Liabilities are defined as a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow of the entity's resources. So this is really similar to assets. A present obligation refers to you being required to do something. So if you're given an invoice that needs to be paid, this is a good example of a liability, because you have an obligation to pay that invoice. We already discussed what an entity was when we were speaking about assets, so I won't cover that again, as well as past events. However, the settlement of which is expected to result in an outflow of the entity's resources is another way of saying that you're going to either pay cash or trade an asset in order to settle the liability, so that you no longer owe it. So in a way, a liability is almost the opposite of an asset. Instead of you owning something that is going to earn the business money, you are obligated to do something that will result in the company having to pay out money. The final part of the accounting equation is equity. So let's briefly have a look at what that is. Under IFRS, equity is defined as any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. This is essentially another way of saying it's net assets. If you get the assets and you take away the liabilities, the residual assets is what the equity is. So you can understand why the accounting equation is assets equals liabilities plus equity, because the surplus of, because if you were to deduct liabilities from assets, then that residual amount, that balancing amount, is essentially equity. Equity can be really complicated. It can be made up of several things such as shareholder contributions, dividends, and retained earnings, among other things, but I won't go into that in this video. So now you're probably wondering how this has anything to do with debits and credits. Think about it this way. If you were to have an asset and you put an entry in to increase or decrease your assets, that's going to throw off the accounting equation, because assets is going to change, whereas liabilities and equities will stay the same. so they will no longer equal each other. So the point of debits and credits is to ensure that whatever happens on one side of the equation also happens on the other side of the equation. And we need to ensure that the accounting equation stays balanced at all times. So now that we understand the point of debits and credits, let's discuss what should be recorded as a debit and what should be recorded as a credit. So transactions that we recorded as a debit are expenses, assets, and drawings, whilst anything that is recorded as a credit is a liability, income, or capital. You can also think of debits and credits as the inverse of each other. So if you were to decrease an asset, you would credit, and if you were to decrease a liability, you would debit. I hope this kind of makes sense. As we mentioned, a debit is an asset, so if we're removing an asset, then it would be the opposite of a debit, which is obviously a credit. The way that I was taught to learn these is dead click. Debits, expenses, assets, drawings; credits, liabilities, income, capital. So let's look at an example of how to put this into action by using some real life examples. So you're a business and you operate out of a commercial building. You receive your invoices through email and through post. You come into the office one morning and you see that there's a water bill on your mat. So you open it up, you take it over to your desk, and you're about to put it into your accounting system. The first thing you would need to think about is what the entries will be. So, as we know, purchase invoices are a liability because they are a present obligation to pay the supplier for your water. So we know that it's a liability, which is a credit, and it's also an expense, which is a debit. So our double entry would be debit, expense being the water account, and credit, liability, which would be your accounts payable. Now, let's do another example, but maybe from the point of view of you making a sale. You're in your commercial property and your business specialises in selling computer software. So customers go online, they download your software from your website and they pay you through a payment portal. As soon as that money comes in, you need to recognise that as income. Now, if you think about what's actually happened, money has come into your bank account and that signifies that your bank account is increased, which is an asset, because cash is an asset. So an increase in cash is a debit. You also have made a sale, so you need to recognise that as income. We know from dead click that income is a credit, so you would need to credit your income ledger. So our double entry for this would be debit cash, which is the asset, and credit income because we've made a sale. So to recap, we've gone over the accounting equation, what it's made up of, how this relates to debits and credits, and how debits and credits work in real life. I hope you enjoyed the video, and if you enjoyed it, please feel free to subscribe and give the video a like, and I'll see you in the next one.